In this video, we want to deal with each of the other items that we have on the income statement. You will see that the revenues are a very important number in that it drives the whole model. This will be true for any valuation model that you do. There are many things that will be a function of revenues, either implicitly or explicitly. The cost of goods sold here is directly a proportion of revenue, but you'll see that SG&A, rental, even depreciation will be, in a sense, implicitly a function of revenue in that they are a function of how the firm is growing over time. Let's turn to cost of goods sold. What are the assumptions that we have for cost of goods sold? Well, the case tells us that cost of goods sold are 20% of revenue, and so we want to reflect that in this income statement. Let's again activate our cell with equal. We're going to go to our assumptions spreadsheet and use the 20% of revenue assumption that we have on there. Again, ask yourself, does this change for year by year? It does not. And so we want to fix this number again using the dollar signs around B and around 6. Notice the formula up here. I again have $B, $6 for pointing to this 20% number. This will now be multiplied by what? By the revenues that we are producing in each year. And so here I have the cost of goods sold are 20% of revenue, and that is reflected by the formula as well that I've inputted. Notice that I never go into these cells and type in 20% times the revenue. You always want to be able to point to another cell where you have your main assumptions and leave this income statement as much as possible just with formulas pointing to your assumptions. That allows you to, in the future, if you think that the correct margin number is not 20%, but rather 25 or 30%, you can turn to your assumptions, change that number, say to 30%, and that would be reflected in your pro forma statement in every cell that points to that cost of goods sold assumption. So I will keep going here, and gross margins are defined as revenue minus the cost of goods sold. So I will do that here. So the gross margin for 2018 is $1.6 million, and that is consistent with what you have in your case in the second sheet, where you see revenues of $2 million, cost of goods sold of $400,000, and a gross margin of $1.6 million. We can keep going and now consider the sales, general, and administrative costs and the rental. Now those two, the case says, are paid not just on the stores that you already have, but also on the ones that you're building. Potentially because you already have to rent the space in order to build your store in it, and because there's other expenses that accrue as you're building your stores. So the sales, general, and administrative, the logic is going to be the same as what we did for revenue and cost of goods sold. We want to go back to our assumptions sheet. We know that these are $3,000 per store per year. We again want to fix that number. And then we want to multiply that, importantly, not by the existing stores, but rather down here by the total number of stores at the end of the year. Notice once more that I am not fixing this B18 cell because this will change year to year. And so I want to leave that floating as I drag that formula to the right. The same is going to apply to the rental. You want to choose the $30,000 in rental and then multiply that by the total number of stores that you have at the end of the year. We can take these four elements of the income statement drag them to the right, or you can also alternatively copy and then paste all of these numbers to the right. And notice what we have now. We now know, given our assumptions for our company, that our gross margin is right now $1.6 million. That will keep growing and double to $3.2 million by 2023. You also see what is happening to sales, general, and administrative expenses over time. And also similarly to rental, you're now spending $600,000 in rental. That will grow as you double the number of stores to $1.2 million. And you have a lot of information here. And you can think about whether each one of these numbers makes sense given what you think will happen to your company in reality.